Hey, everybody, this is Jeffrey Dunyan, CEO and founder of Safe Option Strategies. Welcome to our Moving Markets podcast, the Safe Option Strategies Daily Market Recap. Today is Friday, January the 19th, 2024, and my day has not gone how I expected it at all. So I'm recording this it's probably been 5 hours since the market closed today. I'm so far behind schedule in what I wanted to do. Had some meetings that went late and didn't get trapped in a snowstorm or a blizzard up on the mountain like I did on Wednesday night. But been a busy day, so I'm just getting to this, and my apologies for people that were expecting this to hit the website sometime shortly after the market closed. Let's start out today by just recapping really quickly a pretty incredible day in the U.S. stock market. S&P 500 up 1.23%, setting a new all-time high, passing a record that it set in 2022. Dow Jones Industrial Average, I believe that closed at an all-time high. I think it only needed about 200 of those almost 400 points to the upside to be finishing at a new all-time high. And the NASDAQ, while not at a new all-time high, still had an incredible day. Percentage-wise, best of the three indexes, the three major indexes, up 1.7%, 255. Things started out this morning a little bit to the upside, but really picked up some steam and got going. I want to say it was right around, let me give you an exact time here. You'll be able to see on this intraday chart. They floated around for the first couple of hours of the market, a little back and forth, all in positive territory, had a little spike up about 11 o'clock Eastern, fell back away just a little bit, and then just got on a roll. Starting about 11:30 Eastern time, just got on a roll and had an incredible day to the upside. A lot of this upward movement was based on a couple of things. Number one, the NASDAQ really led the way with that 1.7% move up today. The NASDAQ really led the way with a lot of hope about how AI is going to affect the markets this coming year. There's people that traded in the mid to late 90s. Remember when the internet was blossoming and burgeoning, and people started doing online trading for the very first time. And it seems like if you came up with a clever name and put .com behind it, chances are you were gonna make $1 million. That there's a similar feeling to that right now with artificial intelligence and with the world of AI, and of course a handful of companies that really lead out in that are actually going to be a couple of companies that we talk about in just a minute. There's also some hope, some renewed hope. Even though the Fed has been saying otherwise, people are still buying into this notion that there are going to be a lot of rate decreases this year, and that they're going to start as early as the March Fed meeting. And I'm still not in that camp. There's not a lot of people thinking that the meeting at the end of this month is going to bring a rate hike. This 97.9 number suggests that the current rate is going to stay where it's at. But you get into March and you've got almost 50-50 split. You get into May, you've got 88% of people. You add these two numbers together, just adding these two numbers together really quickly. I'm sorry, 83 plus the little 0.7 there, maybe say 84, 85% of people are leaning towards a rate cut in the month of May. Fast forward 6 weeks to June, you've got about 82% think there's going to be a rate. Actually, I take this kind of assumes that by that time, this is where rates will be, and people think they're going down here to the 4.75 or 500, and it just goes on and on and on throughout the year. This hope, which I think is very misplaced, I really think it's very misplaced, but this hope of rate decreases is what helped fuel things once that fire got going. It helped fuel the fire, and so pretty incredible update, pretty amazing way to end the week. It has not changed what I've been talking about. I still believe that between now and the end of first quarter and into maybe the middle of second quarter, I still think we're going to end up in a pattern somewhat like this. Now, obviously today was up. Maybe we touch something up here. Maybe we move slightly into overbought territory again. and then start that decline. I'm still of the opinion that we're going to hit some headwinds in the economy, and we're going to start to see some things go down. A lot of this movement lately has and all through last year, to be quite honest, was built around the strength of the consumer. And if you listen to Jamie Dimon, and I don't always agree with everything that Jamie Dimon says, but if you listen to Jamie Dimon, there's going to be some weakening in the consumer. You're going to have a consumer that is tapped out on credit cards, that is not having their wages keep up with inflation, and they've run out of savings and they've run out of money that they stockpiled during COVID. And I think that consumer strength is going to start to show. I'm also not sure I completely buy into the unemployment numbers, and I think you're seeing some cracks. Company after company continues to announce layoffs. This morning, before the market opened, you had another couple of companies that were talking about some pretty good size layoffs. And if that continues, you cannot have these low unemployment numbers as long as they're going to go. So that's kind of the state of things and what happened in the market. Now, yesterday I teased out that I was going to share with you my list of must-have stocks. Now, let me explain what I mean by this. I know a couple of these stocks are expensive stocks. It'd be hard for someone to hold more than a few shares, let alone several hundred shares. A couple of these stocks are smaller price stocks, but not real small price stocks, or low price stocks, I should say. But these are companies I think you should be trading. A company, for example, one of the companies I'm going to talk about in a minute is Costco. Costco is not a cheap company. It's not easy right now to own a lot of shares in a portfolio that's $50 to $100 to maybe $200,000, a nearly $700 a share stock. That's not easy to own a lot of shares of that stock. And I personally will not own stock if I cannot own at least 300 shares of something. I'm going to grab my calculator, make sure I don't screw up the math on this. 300 shares times a $696 per share stock, you got to have $208,800 right now to own 300 shares of Costco. So it's not easy to own a lot of shares of this for the typical retail trader with somewhere between $50,000 and maybe $200,000 in their portfolio. But Costco is a trade that you can be bullish on through a variety of different option trades. I am probably going to start a long-term call calendar or bull call calendar, a horizontal or a diagonal trade, but using leap long options for the anchor part of that trade, and then nearer term short options that are at a higher strike price. That's the way you can have Costco be a part of your portfolio, but not have to own a lot of shares. So I'll come back around to Costco in a minute. But as I go through these companies, these are just companies that I think for this coming calendar year should be on your watch list. If you're not trading them in actual stock ownership, I think you should find a way to make them a part of your portfolio through smart option trades. You want to learn more. If you're not a member of Safe Option Strategies, you want to learn more about the option trading, you need to check out our site at sostrades.com and look into how to become a member, where we teach you all of that. All right, I'm going to start off with what I'm honestly picking as my number one stock of the year, and that is AMD. Now, I know a lot of people are really, really big on NVIDIA right now, and I am as well. And it was not easy to choose one of these companies or the other one. NVIDIA got a huge boost with the announcement of Facebook, Meta, investing over $1 billion in their AI chips. But here's the thing about NVIDIA. NVIDIA, number one, it's an expensive stock. It got close to $600 a share today. I think at one point in time, $595, and it finished just you might not be able to see that, but up here, its high of the day was $595, and it finished only 9 cents down from there on the day. So had a phenomenal day. This has been a fantastic run. But when a stock starts getting up around this price, for NVIDIA to go from, $200 to over $400 a share last year, which I think it did even more than that, that's impressive. Over 100% gain. I think NVIDIA was up 200% or more. But when you start becoming a $600, a $700 stock, it's not as easy just based on simple math. It's not as easy to double that in size. I think NVIDIA is a great company. I would not try and dissuade anyone from being in NVIDIA, but AMD right now is sitting at about where NVIDIA was a year, maybe a year and a half ago. It's having a similar type of run, but to go from 175 to 350 is a lot easy. Oh, that's a horrible five to go to. I should just give up on that right now. To go from 175 to 350 in some ways is an easier thing than to go from 350 to 700 or from 700 to 1400. So it was, like I said, it was not easy to pick between these two companies. AMD right now has a little bit smaller multiplier as well. And so that it's a little easier to afford at $175 a share. Having 300 shares of this in your portfolio, $52,000. That's still a lot of money, but that's for a lot of people that's doable. That's maybe a third or a fourth or less of their portfolio, and it's not a horrible thing when you know how to collar trade. To park a quarter of your money into one company if you think that company has a huge upside potential. You can still do things with the option trades to go along with it. So these are not necessarily in a specific order of which one I like best, but I'm leading out with AMD. That would be the first company on my list this year of must-own, must-have companies. All right, the next two companies, the analysis for one is identical to the analysis for another. I believe that it had a little bit of an off day today. I'm not too worried about that. The recent move has been very nice. I am not worried at all about a little bit of an off day today. Walmart and Costco. I'm going to talk about both of them almost like I'm talking about one company. Now, obviously, shares of Walmart trading around $162 a share, much, much easier to own a lot of that in your portfolio than shares of Costco. But like I said, you can do option trades when you can't afford to own more shares of the stock. I believe these are two of the most recession-proof companies in existence right now. And I'm not predicting that we are going into a recession, but I believe it is still a possibility. And you do hear a lot of market analysts talk about rolling recessions, where we might not have the overall economy be in a recession at one time, but certain segments of the economy may go into recession territory and have a couple of quarters in a row where they contract. And then as they emerge out of that, other sectors of the economy might doing that. In some ways, that goes hand in hand with stagflation, which was really the killer of Jimmy Carter's administration, and the struggle with high inflation that people suffered through the late 70s. I was really young at that time, but I'm old enough to remember my parents being in gas lines to get gasoline. I haven't seen that since that time, but I remember when it was happening at that time. Costco and Walmart, great companies to own. They'll have some bumps, they'll have some ups and downs, but these are very recession-proof companies. All these people that want the Fed to cut rates multiple times throughout the year, I hope they know what they're asking for, because quite honestly, the only way the Fed is likely to cut rates more than 2 or 3 times this year is if we are in a recession. So you better be careful what you wish for, because you get that many rate decreases and we're probably in a full-blown recession. Now, again, I'm not predicting that, but I'm telling you, if we get to that, there are not two more recession-proof companies than Walmart and Costco. So I've mentioned both of those. I'm going to go back around to the world of tech for a moment. This would be my fourth company, but again, these are not necessarily in order. Another kind of expensive stock, but I believe this is one of the companies that is going to, I put the wrong ticker symbol in here. I believe this is one of the companies that is going to lead the way in artificial intelligence. I think Microsoft is poised to be, there's other companies that will participate. There's other companies that will be huge beneficiaries of this technology. I think Microsoft is one of the most well-run technology companies out there, and where a company like NVIDIA is going to provide the high-speed chips that are going to make AI possible, Microsoft, I think, is going to be at the forefront of putting together the infrastructure and the programming that makes it work. And again, it's not that I don't like companies like Google. It's not that I don't like other companies that are going to be very heavily involved in AI. Microsoft is the one that I picked. And again, it's kind of a pricey stock, but you use synthetic collar trades. You use Leap uh, calendar calls and bull call calendars, and you do those kind of things in the place of being able to hold a lot of the shares of the stock. All right. My next company is more of a hybrid. They are a tech company and they are a retail company, and I just think we've only barely begun to see what Amazon is actually capable of. And I say that after a company that has been incredible for the last 15 to 20 years. I still to this day kick myself repeatedly for not buying shares of Amazon back when they were in the $50 a share range and had never done a stock split yet. Amazon, what were they up $1,100-$1,200 or more when they did like a 10 for 1 stock split or a 20 for 1 stock split, something like that. I mean, this company is just incredible. Like Costco and Walmart, I think it's up there in that category of being recession proof. Amazon is subject to a little more of the whims of earnings reports that focus on their AWS, their Amazon Web Services, because they're a hybrid technology company. Along with, I mean, they're a space company as well. They're a technology company. They're a space exploration company. I know that's a spin-off company of Amazon, but they're going to be affected by things like that. But they're also a retail company, and they still dominate in a big way online sales. Walmart's made a lot of progress in that respect. That's one of the reasons Walmart is on my list. But Amazon still leads the way by leaps and bounds in terms of online shopping. I've shared this with members of Safe Option Strategies before. Every single year since the first time I started doing some Christmas shopping on Amazon, the amount of Amazon shopping has increased. The amount of retail store in-person shopping has decreased. This last year was probably 90-10. I probably did 90% of my Christmas shopping on Amazon. I probably do 90% of my non-grocery shopping on Amazon, period. It's just, I think it's a fantastic company to own. Not horribly priced if you want to own a few hundred shares of it, but again, you can take advantage of the option plays. All right, I've got two more that I know you're very familiar with. One that is going to be my dark horse pick of the year. The next one I want to talk about is ExxonMobil. Now, I am of the opinion that the things going on in the Middle East right now are eventually going to hit the oil and the energy industry in a big way, and you're going to see the price per barrel of oil go up pretty dramatically. The fact that oil has been sort of suppressed for a while, and I don't know what else to call it. I think the Biden administration's allowing of Venezuela to sell oil again, some of the dirtiest oil produced anywhere in the world. The fact that they will not actually enforce sanctions on Iran and are allowing Iran to sell their oil to anyone they want to, specifically Russia and China, and gather all the money to wage their war against Israel and against the West. I think it's only a matter of time before we reach kind of a tipping point and you see the price per barrel of oil start to go back up. And at the very least, I think you'll see ExxonMobil go from where it's at back up to its 6-month highs and beyond, maybe to new highs. Now, percentage-wise, that's not quite as big a jump as what I think some of these other companies could do, but ExxonMobil pays a decent dividend. I think it's a safe bet. I think this is a safe place to park money for a long period of time. And at $96 a share, so far of the ones we've looked at, a little bit more affordable. Last but not least, I'm not real big into ETFs, but I believe more than I ever have in the past that this is the year to own some gold. And I'm not a big fan of owning physical gold. When I see the commercials and I see people that want to own physical gold, the thought that always comes into my mind, I have a handful of gold coins. I got them when they were worth $1,200. They're worth almost double that now. So I know they go up in value, but if there were some type of a zombie apocalypse doomsday scenario, I'm not predicting that, but and I'm being a little facetious, but if there were some type of pandemic type situation, or hurricane or flood or tornadoes, whatever the case is, and all you had to barter with, the only thing you had to barter with were the physical coins that you have in your possession, what are you going to spend a gold coin on, even if it is worth $2,500? It's not going to be worth much to go out and barter with, because you're going to want a loaf of bread, and someone's going to say, "Yeah, I'll take your gold coin," but they're not going to give you any change for it. And I'm exaggerating a little bit for effect, but as far as emergency money, I believe in having some much smaller coins, and some really small dollar bills. The emergency money that my wife and I have put away is mostly ones, fives, and tens, and a lot of coins. We've got a lot of quarters and dimes. That's what people are going to use when they can't go to an ATM, when the internet's down, they can't use their Apple Pay, their credit card won't work because of electricity being out. If we get into a situation like that, let me tell you, not such a far-fetched scenario. We know that China has tried to hack our electric grid on multiple occasions. What would you do if tomorrow you had to go to the grocery store and every sign there said cash only, and you needed $5 worth of stuff, and all you had was a 20, and because the grocery store doesn't have endless loads of hard currency cash on hand, they say, "Look, we can't give you change. If you can't make the exact change, we'll take your $20 bill. You either go find $20 worth of stuff, or we'll take the $20 bill for the $5 worth of stuff you have." Now, that's still a little doomsday, and I don't want to sound like I'm a prepper or anything like that, but that's not as far-fetched a scenario, to know that your electricity goes out. It doesn't even have to be a Chinese hack. A hurricane comes through Florida or Texas, they can be without electricity for weeks, and you're going to want some smaller dollars. But with all that said, I I do like the GLD ETF. And I think gold, if we see some more economic weakness, if we see some recession, I think this would be a good place to have some money. Again, little bit high price, couple $100 a share almost, but I think it would be worth it to either play it with options or to play it with the shares if you could afford to own them. Now, I'm going to give you my dark horse, and this might surprise some of you. And I'm having fun with all the jokes about it. A couple of my friends already know that I own some shares of this and that I'm trading it, and they're getting a kick out of the jokes that they're making about it. One of an analyst that I listen to and pay attention to from time to time was on Fox Business News the other day, and I thought he made a very compelling case for this company. Hims Hers is probably most known for their generic Viagra and their generic Cialis, and it even says right here in the description of the company, including those related to sexual health. But hair loss, dermatology, mental health, and primary care, Hims Hers is expanding dramatically and rapidly. They are expanding into other things besides just the ED and the men's sexual health stuff. This is a very affordable, very low price stock. And the way they're expanding, they have poised themselves as one of the most recognizable names. And at an $8.50 a share stock, they are also a very well run business. They're one of two things I think is going to happen this calendar year. They're either going to have a larger company like Aetna, like Cardinal Health, like United Health is going to come along and buy them because of the infrastructure that they have in place and how well they are expanding their telemedicine operation. And that's the real key to what they're doing, is telemedicine. I did some consulting a couple years ago for a telemedicine company that focused primarily on mental health, and it is a burgeoning business. It is a very rapidly growing business, and it's becoming more and more popular. The pandemic put it on steroids. I believe this company in the upcoming calendar year could go from this $8.50 range, where it's been kind of stuck for about a month and a half or 2 months. I think this company in this calendar year has the potential to be worth $15 or $16 and double in value. And because it's only $8.50 a share, it is a very easy company to own a lot of. Now, the jokes continue to fly. When I first started looking at it and considering it, the stock was trading down here, and I can't tell you how many times myself and a friend of mine talked about the stock is up again today, and look at it having a huge day, and I mean, you name it. We had every joke you can imagine. The most recent joke is it keeps hitting up against a very hard level of resistance. Or a very hard level of support. We're having all sorts of fun just because of the nature of this business. But all joking aside, I think their expansion into telemedicine, into the hair loss, especially the mental health, that's becoming a bigger and bigger issue in our country every day. And the awareness of it is becoming greater, and the willingness to address it is becoming greater. I think their expansion into that, as well as some primary care through telemedicine, is going to, forgive me, I can't help myself, it's going to make this company huge this year. Okay, enough with it. I promise. No, I can't promise that I'm done with that. I honestly, I can't resist one more. I could go all day. I could just come up with these all day. I'm sorry. Anyway, got to have a little bit of fun. You own a company like this, you have to have some fun with it. And no, in case you're wondering, I am not a patient of theirs. I've never used their product, but it's fun to make the jokes and have a laugh at it. All right, so that is our official and formal watch list for 2024. Now, there are other companies that have been a part of my portfolio for a long time that I am going to continue to trade. I am going to continue to do spread trades on Tesla. I'm going to continue to do spread trades on Micron. I'm going to continue to do spread trades on JP Morgan. I'm going to do spread trades on Caterpillar. These are companies that I had very successful trades with last year. NVIDIA, Levi Strauss and Company, Ford Motor. I own a lot of shares of Ford Motor. That's the biggest single holding in my portfolio, because it's one of the very first companies I ever collar traded, and I have a lot of shares of Ford. I don't plan on getting rid of those, even though they've been beat up a little bit lately. I'm not going to stop trading those companies that have been a core part of my portfolio and a core part of my spread trade profitability anytime soon. But these, what did I give you? I think 8 companies. These 8 companies that I just listed off to you, these are going to be the focus of a lot of my new trading this year, and some of my, I've had Walmart for a little while. I've owned Costco from time to time. I own some Amazon and some ExxonMobil now. So even some of these are companies I already own. But if you're new to the market, or if you're just looking to kind of refresh a stagnant portfolio, maybe reposition a little bit, these are 8 companies that I think you absolutely want to make a part of what you're doing this year. All right, folks, once again, I apologize for getting this up as late as I am in the day, but have a great weekend, and we'll be back Monday to recap what the market does on Monday. Thanks, everyone. Bye-bye.